The Bank of Canada has delivered a jumbo-sized 50 basis point rate cut today. Joining me now to discuss the decision is Francis Fong, senior economist with TD. And Francis, heading into this, there's a lot of uncertainty whether it's going to be 50 or 25. Did the decision ultimately surprise you?
Yeah, this was obviously a tough one, Anthony. I think if you sort of look at the underlying data of what the Bank of Canada was walking into this meeting with, there were signals, I think, where you could argue in favor of a larger rate cut, as they ultimately did, or perhaps, the size of cut that we've seen in the past couple of meetings, which is just the regular 25 basis point cut. Things like inflation, where headline inflation is already back to target, but core inflation is still rising a little bit above that. We have the unemployment rate at 6.5%. I think you could argue that that's a certain amount of weakness that might call for a larger cut. But we also see things like wage growth that is still running pretty hot. Unemployment rate, in terms of absolute terms, falling. Job growth, that's still pretty decent. So our call was for a 25 basis point cut, but ultimately the bank decided to characterize that sort of economic framework as being justified for a relatively larger cut. So, not a huge surprise, but certainly I think a surprise in terms of where they were relative to their forecast. They had a fairly strong forecast heading into the last sort of monetary policy report that they released, and yet they decided this time that they would characterize that as sort of weakness justifying a larger cut.
Yeah, and I want to talk a little bit about their statement today because they talked about the softness of the labor market. Do you think we can expect another jumbo-sized rate cut in December?
Yeah, I think that's going to be top of mind for a lot of folks right now. I think it's important to sort of characterize that this 50 basis point cut is sort of the odd man out of the larger sort of cutting framework that we've seen from the bank, because we've already seen them do several 25 basis point cuts, and then all of a sudden right in the middle we have this larger 50 basis point cut. Does that kind of justify further jumbo-sized rate cuts? We would argue no, simply because this does sort of represent the odd man out of the cuts. Given where the sort of overnight rate is right now, and given where their forecast is, certainly with this updated forecast that they just released, they do have core inflation sort of getting back to target by the end of next year, which would argue, I think, maybe a more consistent pace of rate cuts that would bring them back to neutral territory sort of by the end of that point. So I think we would largely call for 25 basis point cuts interspersed with some breaks, getting back to neutral by the end of next year.
Okay, let's talk a little bit about the loonie because it has lost a bit of momentum after this decision. How do you expect it to perform going forward?
Yeah, the CAD is definitely a bit of a tough one these days. With oil where it is, you would anticipate some movement there, and yet we've seen almost no movement going around. And I think that's largely because, markets are sort of depending on rate differentials between Canada and the US to tell that story. So, given where pricing was heading into this meeting, you had sort of equal-ish bets, betting on a smaller rate cut versus the larger rate cut, and then ultimately the larger rate cut winning out. We did see that small correction kind of heading into the day, but that being said, I think where market pricing is right now for the Bank of Canada is sort of moderate that pace of rate cuts going forward and let the Fed catch up. That rate differential story sort of evens out, and so we anticipate the CAD to sort of strengthen mildly, I will put it, mildly from here on out, but to a point where, we're not really going to see too much CAD strength, I think, over the medium term.
Now, I want to talk a little about the risks to the Bank of Canada because we have seen this 50 basis point jumbo-sized rate cut. Do you see any risk of inflation reaccelerating or even the housing market reheating after this latest rate cut by the Bank of Canada?
It's a good question, and I think I might characterize it slightly differently in the sense that if we look at where inflation is today, a lot of the components that were driving inflation are either weak or turning. So we have things like gasoline prices, food prices, and a lot of other sort of core spending that is at this point in negative territory, so in deflationary territory, at least on a year-over-year basis, whereas things like ownership costs, rent, those have started to either peak or starting to come down. So I think at this point, the bank is looking at that trajectory and thinking, well, we no longer need interest rates to be in as restrictive territory as we've seen, hence the jumbo rate cut that we saw today. So I don't anticipate inflation will sort of, kind of all of a sudden reverse. That being said, that it certainly is a risk if we do see growth pick up, but that's not really in the forecast. From the housing market's perspective, I would characterize it in a slightly different way in that we've seen sales activity essentially flatline over the past little while, but prices haven't really come down all that much. So to the extent that we do start to see sales activity, I would anticipate that, given that we've already seen a correction in mortgage rates, and this rate cut will sort of just continue to spur that on. And so we would anticipate sales activity to pick up a little bit. From a price perspective, I think there's a little bit of catching up to do for sales to kind of translate into that higher price activity.
Okay, and going forward, what are the indicators that you'll be watching closely as the Bank of Canada considers its next move?
I think it's a little boring to say this, but ultimately we're going to be looking at those basics. We're going to be looking at where the labor market is headed, how the inflation data comes in, and how that performs relative to their forecast. They obviously update, every once in a while, and every time we see a new forecast, how they've updated, how the updated data moves relative to that will sort of justify, certain size rate cuts. But at this point, given where they're anticipating and where we're anticipating the Canadian economy to go, I would continue to anticipate that sort of moderate pace of rate cuts going back to neutral going forward.
Francis, thanks very much for your time.
Always a pleasure, Anthony.